Hello and welcome to Forex Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing what's driving the pound. The British pound has been affected greatly by the coronavirus outbreak. As per the image of the GBP/USD daily chart, the 7-day period at the beginning of March saw price collapse from a level of 1.32 to 1.14. However, it has had a phenomenal rebound to the current level of 1.25. And so what has led this recovery, and is it sustainable? First, we have to factor in the early stages of March, where Britain was hardly hit by the coronavirus, and the government decided to close the bulk of the business sector down by putting the country into lockdown in order to try and curtail the effect of the coronavirus. It implemented financial strategies to inject capital into the markets in order to try to protect small to medium businesses, while also agreeing to make financial payments to individuals who would be on lockdown. This has created a debt bubble. The shockwave to the financial system was huge and sent the pound crashing against the counterparts and especially the dollar. But also at this time, the United States was in the early stages of the pandemic, and this would have influenced investors and currency traders to buy the dollar against the pound. During these later stages of March, we can see that the price action is heavily supported around the 1.14 level and the 1.15 key levels. As the United States becomes more susceptible to the virus, with increased numbers of people being infected, the death rate begins to rise. Analysts will also argue that huge amounts of dollar being injected into the markets by the Federal Reserve, the slashing of interest rates, and their huge overnight purchase program, which effectively provides more stimulus, has greatly helped liquidity in the financial markets, where the UK is heavily dependent with its huge financial services sector, thus giving the pound a lift. This being said, from 1.14 to 1.25 in 6 days, not many traders saw that coming, especially market analysts with the country in lockdown. With increasing unemployment, businesses going through the wall, and government debt growing exponentially, while essentially propping up the country, we have to factor in other critical components as to why the pound is so elevated. Firstly, we have the USA in a similar situation, where a majority of the individual sector has also been shut down, and where the majority of the population, excluding essential and key workers, have been put into lockdown. Of course, these workers do not contribute to the country's gross domestic product, as such they make a negative contribution to the GDP, due to the salaries and equipment that they need, which all comes from the federal government. Again, this is bad for the US economy, and so we would expect a bounce in exchange rates to take some of this into consideration. However, we suspect one of the key reasons for the GBP/USD exchange rate is elevated at the moment is because the investors envisage that the British government will not be able to effectively negotiate the terms of the new trading agreement with the European Union, where Britain's transition period ends at the end of December 2020. Although this is enshrined in law, analysts and investors are predicting that the government will have to find a way to extend this period by 1 or 2 years, simply because the pandemic has meant that the British companies are not in a position to effectively be able to implement any new trade deals that the government negotiates with the EU by December. This forces the government to extend the transition period, and this of course would mean that uncertainties surrounding negotiations will be pushed back, thus alleviating pressure on the pound. There is one more thing to consider, that the pandemic is forcing the global economy into recession. It's almost unprecedented on this scale, and where we see large swings in the currency pairs such as we have seen in cable, where huge volumes of stop losses will have been incurred by vast amounts of traders and institutions. Often you will find in the circumstances volume begins to dry up in the currency terms and investors stay on the sidelines. This causes high levels of volatility and vacuums, where traders cannot predict levels of resistance and support because there is a lack of historical technical analysis levels of support and resistance. This adds fuel to the uncertainty. We should expect more volatility in this pair. However, as price action consolidates, we will likely see more levels of support and resistance being observed by traders looking for signs that the pandemic is easing. This will happen before finding more clarity with regard to directional bias. If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.